Markets around the world are mixed, and when markets trade the way they did today, it normally tells us one thing: uncertainty. Tomorrow's CPI print has the market on edge because they have no clue what tomorrow's print brings. So instead of making bold predictions, I'm just going to bring you the facts, the data, and the stats. We're going to be talking about how to effectively hedge your portfolio if the market is to correct in the next coming weeks and months ahead, because at the end of the day, protecting your capital is even more important than making money. We're also going to be talking about smart money. What are they buying and what are they selling ahead of CPI? And valuation. Many claim the market is expensive, so I'm going to show you where you can find growth and diversification at a reasonable price. So keep all hands and feet inside the vehicle at all times. We're going to be moving quickly, so let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell. Let's get into it. A very light day in terms of news in the market. Really, there wasn't much to say. I mean, the biggest thing was that some of these mega caps were down quite big, but others were up. I guess you could call it the mega cap value names like Apple, Google, but Meta was down as well. We just saw underperformance here in Lilly relative to the market, Nvidia, as well as industrials, but they've just been extremely strong. We saw a performance here in financials, energy, materials, as well as consumer defensives and utilities. Let's actually hop on the sector chart. We can see that GDX, XLB energy, like the material sector, really doing the most work, followed here by staples and utilities. And then we also had some of the cyclical names, software, financials, healthcare. They all beat the SPY. What underperformed the SPY was technology, discretionary, communication services, real estate, and then semiconductors. All in all, I think the market is just awaiting the CPI report tomorrow, and that's what traders were positioning for. Some were taking money off the table, others were deploying money in defensive names, as you can see right here. And it's all just for tomorrow's CPI report. Quite an important CPI report just to see where inflation is going to sit, especially relative to the January adjustments. But let's hop on the charts. Now, this is the S&P 500 chart, but before we dive into the specifics, let's actually have a look at indices. Look at the S&P 500 down 0.1%, the nasdaq down 0.37%. The RSP actually gained in the day's trade, up 0.13%. Very bullish when you look at that. Mid caps, small caps down 0.45%, 0.48%, and then the IWM slightly higher beta down 0.79%. All in all, fairly negative day across the board, but not as negative as I would thought it would have been based on Friday's trade. Now, looking at stuff like gold was up on the day, same with the dollar, same with oil. We can see that Bitcoin doing the most work, up 0.453. It's on like a 70% run for the year. Actually having a look at the Bitcoin chart, you can see on a weekly chart closing at the weekly high, the highest weekly close ever. And then looking at the daily chart as well, the highest daily close ever. You don't really want to fight this trend. When you see stuff like this, right, move into candles like this, you don't really want to fight this trend. We've had one green candle in probably the last 2 to 3 weeks. These are very strong candles right here. You can see long lower wicks, short upper wicks. So like dips are getting bought all the way up. We closed at a daily high, and that's super bullish. And I think the crypto bros are right. I think this is going higher. I'm not going to speculate how much higher, but I think Bitcoin is going to go higher. Now looking at the S&P 500, this is the weekly chart. Not much to add here, but looking at the daily chart. Now looking at candle structure and location, this is a green bodied candle. They call it a green hammer doji. We actually gapped down from Friday's close, closed that gap to the upside. The sellers did put in work early, but so too did the bulls. Bulls found value at the equal low here from Wednesday. This is going to be a huge line in the sand tomorrow. And I did say that in my weekend video, what the bears really need to do early on in the week, Monday, Tuesday, was get us to this 50-57 level here, break below users resistance, and then we probably will go to these levels right here. What bulls need to do tomorrow is use this equal low that they've put in as strong structure to keep the rally going. Now we do have a big macro event in CPI tomorrow, and that's really going to determine everything. My personal opinion is that we're going to come in cool. A lot of people think we're going to come in a bit hot. I think the price increases in January are just hard to adjust for seasonally. That being said, you don't actually want to predict what that CPI print is going to do for the market. You want to react to it. All I'm giving is just my outlook and my take. But hopping on the 5-minute chart, you can actually see sellers took us down very early in early trade, the first half an hour, and then we rallied pretty much for the rest of the day, putting in higher highs, higher lows. Not great structure, but pretty good structure nonetheless. We did actually go ahead, close this gap as well, and very similar situation here for the nasdaq in the 5-minute chart, as well as the RSP, although the equal weight was a lot stronger. All in all, the work is cut out for both the bulls and the bears. The bears need to take us to this line and below. Bulls need to just rally from right here. Although favor is on the side of the bulls, this is an equal low and not constructive for the bears to see this. If the bears really wanted to take us lower, they probably needed a close at this equal low. We actually got a wick low right here, and that probably means we do go higher for the rest of the week. The second the bulls get momentum in a positive gamma environment, just keep rallying. And that's just the thing. In a positive gamma environment, dealers are on the side of the bulls. They buy dips, they support price, and that's why we normally form these equal lows at very key levels. If we actually measure this level out, where is it? It's at the 50.91. A lot of these gamma strikes are in round numbers, so they're at 50.50, 50.100, and that's where you see these turns happen. Sure, it's not an exact science, but it's around there when it normally happens, just 9 points away from the 5100 area. That being said, there's not much to take from today's trade other than the fact that the market is just anticipating CPI tomorrow. Now guys, the weekly poll just wrapped up. The next 100 points in the S&P 500, 40% of you say it's going to go up, 60% of you say down. Now this is a very big number. Normally we actually get it pretty tight, 55, 45, something like that. So to see 60% of you say down, a lot of you are convicted to the downside. Do take it with a grain of salt. This can often be a contrarian indicator. Nonetheless, the stats are there for you guys to see. Now let's talk earnings. Not a big week, but we are going to cover the notable names. And today we're going to talk about Oracle. Oracle reported Q3 total revenue 13.3 billion, up 7%, and the expectation was 13.29%. And then GAAP earnings per share was 0.85% reported. Non-GAAP earnings per share was 1.41. The expectation was 1.38, and the market seemed to like this. Last I checked, Oracle was up like 8% in after hours, so very, very good. Last I checked, Oracle was up like 8% in after hours, so that's a pretty good reaction. And the stock is up like 9% for the year. So Oracle shareholders very, very happy. I didn't check guidance. I'm not sure if they do give guidance, but all else equal, Oracle's earnings should help like software, cloud, semiconductors, technology names too. It really, a rising tide raises all boats. Now, looking at some seasonal data, and often in the market, there's a lot of recency bias. We can put a lot of weight on the day-to-day movement of the market and not necessarily look at the big picture. And sometimes it's just good to look at the big picture and what we can expect and just avoid some of the noise. Now, this is the S&P 500 performance 12 months after we've had a positive December, January, and February. So we had a positive trifecta, as you can see right here. What are the returns we can expect? Now, March tends to be a bit bumpy. 17 wins, 8 losses, right? So about 1/3 of March tends to be a down year when we've had a positive trifecta, but we still average a return of 1.42%. However, what's important is the full 12 months thereafter. 25 wins, no losses, a perfect record, average returns 16%, minimal drawdowns. Only 1 year we had a double-digit drawdown right here in 2011. And when you look at stats like these in the market we are right now, day-to-day movements, whether up, whether down, shouldn't concern you. Buy, hold, and do nothing, especially when we are in a momentum-based market with stats looking like this. Now, most of the time in March, 1/3 of the time it does finish down in the red, and we can actually see some indicators expecting near-term volatility. This right here is when both market cap and momentum factors are up 20% for the trailing 12 months. Generally, market instability does increase. You can see that this happened right here in 2020, 2007, 2008, the year 2000, and then 1998. Now, here are the stats up here: 3-month, 6-month, and 12-month returns. Normally, 3 months returns, we do expect some near-term volatility. 3 months later, in 1998, we had a negative 5.4%, negative 2% in 2000, and 9.35% in 2007, slightly positive in the year 2020, but we did have that big drop initially. So 1 month, 2 months out, we would have been negative, 3 months out positive, which is crazy when you think about it. But then you go to the full year out and you can actually see that it was 50% wins, 50% losses. In 1988 we returned 18%, 2020 we returned 27%, and then the other 2 years were down 22 and negative 40%. But do take this with a grain of salt. This doesn't mean sell in the hopes of getting like a massive bear market drawdown. For any type of data point to be statistically significant, you have to have at least 30 data points. We only got 4 years, so there's not much we can draw from other than the fact that momentum factors as well as market cap factors are up 20% year to date, and history has shown us that volatility does increase in the near term. Now let's assume we get some volatility. How can you hedge your portfolio? Well, one way is actually through gold. Now gold has a unique risk outlier. We could see right here that gold normally returns 8% annualized returns when equities normally underperform. So you can see here that when equities are actually negative, gold is a good hedge because it can actually provide stability in your portfolio. So if we do get near-term volatility, gold can actually be a great hedge in your portfolio. And there's actually plenty of upside left for gold, especially if we get rate cuts. This is a great chart right here, and it's what happens to gold when the Fed stops hiking rates. So the Fed stopped hiking rates in 2000, 2007, 2020, and here in 2023. Now these green periods right here indicate a recession, and then the Fed actually cut rates. When that has happened, gold has went on spectacular rallies. 66% in 2000, in 2007, 189%. In 2020, it went on a 50% rally. And if we do get these rate cuts, do expect gold to rally in excess of, 50, 60, 70%, which is not unheard of. But do take into consideration, it's over a good number of years. It's not in a 12-month period. Now, this is the federal fund rate expectations. Now, we are expecting rate cuts. We could see here that this is the FOMC long run projection, market expectations, and then year-end estimates. Now, the Fed's long run projection is about 2.5%. You're probably looking at 2026 beyond that. But looking at 2024, 2025, we can expect the FOMC expects the federal funds rate to be in the 4.6%, 3.6, and then 2.9% range. So we're probably looking at 2024, 25, 26. What the market expects is roughly the same in 2024 here at 4.48%, but then we do expect 3.37% and 3.6%. So the market actually pricing in slightly less rate cuts than the FOMC year-end projections. Now we know that historically the Fed rarely cuts rates when core CPI is above the employment rate. Now core CPI currently is at 3.81%. The unemployment rate as of last week's jobs report is at 3.9%. Before that it was at 3.7%. So based on the Fed's projections, rate cuts should be coming very, very soon, at least in the next 3 to 4 months. And right now we can actually expect, based on this data, the FOMC projections, the market's predictions, we can expect rate cuts to come in May, June, July, sort of around that time period right there. And normally after rate cuts, that's actually when retail gets going. Households will actually normally start buying equities once rates fall. This is 3 months US Treasury yields and US equity inflows, and we can actually see that when the Fed normally cuts rates, we actually see inflows into equities right there. Same thing right here, inflows into equities, and we've had a massive outflow into equities as rates have come up in this rate hiking cycle. When we do get these cuts, we should see inflows into equities. Now, what about smart money? What are they doing? This is the Goldman Sachs prime book data. Essentially, it's just what hedge funds are doing. This is buying, this is selling, and you can see here that hedge funds in aggregate over the last 5 days and 20 days are net buyers of equities. The most equities that they are buying seems to be utilities and real estate, sort of rate sensitive defensive names, as well as comm services, probably because it is of great value, as well as industrials. Hedge funds continue to sell energy, materials, and healthcare, as well as discretionary. A lot of that has to do with Tesla flows. Hedge funds not liking that. That being said, based on these flows, you could be looking at stuff like real estate, comm services, utilities, industrials. And actually in yesterday's weekend video, I did say that real estate and comm services were probably the best picks over the next 12 months based on their value and the cycle we're currently in. It's actually good to see what I think is of good value and good quality, and what hedge funds are buying sort of align, especially in the last week or so. Now let's actually talk about valuation. So this is the next 12 months price to earnings, next 18 months price to earnings, and then the S&P 500. So I've actually highlighted right here, this is 2013. This is sort of when we had that breakout above the GFC highs. Now a lot of people are comparing this rally to to 2013, and it's not quite the same simply because right here, PEs were sort of around 14, 15, and we did go on a massive rally. In the S&P 500 right now, PEs next 12 months are very close to 20, just above 20, and next 18 months probably like 17. However, what this does look like is mid-caps. Mid-caps trade at a 14 PE right now, and I still think are fantastic value, especially small cap quality, mid-cap quality. You can get great companies, growing earnings, high quality balance sheets, huge free cash flow generation for under fair value, 20%. 15% under fair value. So if you guys are looking for value right now, look at real estate, look at comp services, or look at mid caps, look at small caps right there, especially small cap quality, mid cap quality. Now, if you don't want to hold small caps, you don't want to hold mid caps, you want to hold larger equities, you can actually look at international equities. This is the all world country index, the ACWI, excluding the US. And you can see it's trading at a deep discount to the US, actually trading at a current PE ratio of 13.4 and has a dividend yield of 1.7%. Now, what does exposure look like in this index? You'll be getting actually some very high quality names. You're looking at stuff like Taiwan Semi, Novartis Nordisk, ASML, Nestle, Samsung, Toyota, LVMH, Tencent Holdings, Novartis, Shell. So you're getting a good range of technology, healthcare, some defensive names in there as well. Energy too. So you're getting value, cyclicals, defensives, sensitive names, high growth names. So really good to diversify your portfolio looking at something like this. These are just the top 10 constituents in the ACWI excluding US. Now let's talk seasonality. This is the March seasonal chart, and we kind of are tracking seasonality pretty well. What we do want to see here is sort of a bottom forming. It doesn't have to be at this exact level, but one thing we do want to note is that when we do form a bottom here, if we do form a bottom, what we do want to see is that it needs to stay above the March lows that we made right here. So if we can go ahead, sort of form a bottom there, a higher low, then we can actually look to higher price action. If we do go ahead, let's say go negative for March, break this level, break these lows right here, then things are looking a bit risky for March. That being said, we are tracking the March seasonal pattern. We do revert to the mean. It's not an exact science, but you can see that based on this, we could probably expect higher price action all the way to 1.5 to 2% returns for the rest of March. Now let's talk gamma. So guys, looking at gamma, we still have the call gamma strike here at 5,200. It's actually getting a little bit bigger as we move into OPEX. There's still a lot of positive gamma nodes here. Something to note though, we are getting a lot of negative gamma, especially below this 4,900 level. And here as well, the 5,100 to 50/50 area, there's a couple of big nodes forming here, pretty dense. It's dense, but it's spread out in terms of negative gamma here, right below the 5,100 strike. So if we do get into this area, we can see quite a lot of both positive and negative gamma effects, very whipsaw price action, and then like consolidation. So you'll see stuff like will like go down and then like dense price action like that. And then we'll go up really quick and then like dense price action. So that's generally what you see when you have like that type of tape, where it's both negative and positive gamma. But as long as we stay at this 5,200 strike, guys, no matter how far we pull back in the market, as long as we probably stay above the negative gamma flip zone, we probably only look for buys back to this 5,200 area. But if we start putting daily closes below this gamma flip zone here at 5,510, we start putting daily closes below here, maybe have this call gamma strike move down the tape, maybe to like 5,150, then we're really going to see some downside in the market, and we could really see some downside bearish flows, especially after OPEX into the quarterly OPEX. So we are going to look at a bunch of charts, guys. So we're essentially just going to compare different factors versus the world index as itself. And you can see here that we are in a momentum market. As you can see right here, this chart is going up. That means momentum is outperforming. These charts will all be, if it's going up, the index is outperforming. If it's going down, the world index is outperforming. Now, looking at world growth, we could see here that momentum as well as growth is outperforming the MSCI world index. Now, looking at cyclicals versus defensives, and we could see a very clear uptrend of higher highs, higher lows. And until this actually breaks a significant low right here, I wouldn't look at taking any form of defensive trade, and I still think cyclicals are the best bet, especially with where the economy is, rate cuts, employments, and the secular tailwinds for cyclical sectors. Quality, we could see that for the most part, quality is outperforming the global index, and where you really want to be is growth, momentum, and quality. And generally speaking, quality and growth tend to be in the momentum factor as well. Now, looking at world dividend masters against the world index, index, you can see that dividends have completely outperformed, because why would you go and get a 3.4% dividend that might change year to year? It could increase, it could decrease as well, when you can just go and get a treasury bond paying you 5.5% completely risk-free. And that's why dividends have outperformed. We can also see the same thing for high dividend yield payers. Very much the same thing. People would rather hold treasuries or growth and momentum and quality over high dividend yield payers. But dividend payers are actually attractive right now, and we can see it on full display in this chart right here. This is dividend payers versus the SPY, and normally we trade at this level right here. This is the average, but right now we're trading nearly at 2 standard deviations below the historical average, and dividend payers are relatively cheap. So this is another space that you could actually go look at, especially if we are going to get rate cuts. That's really going to boost dividend payers, and I think a good place for that is actually stuff like real estate. Now, looking at equal weight versus market cap weight, we can see that again, equal weight has underperformed for the most part. There have been pockets of outperformance here in equal weight, but for the most part, market cap weighted indices have outperformed the equal weight in the last 5 years. Looking at small caps, it is better to be in large caps in the last 5 years than small caps, you can see by this chart. However, we could possibly be forming a bottom right here, and this could be the broadening out nature of the market at play. Growth versus value. Growth has completely outperformed value, not just in the last 5 years, but pretty much since 2011, 2012. Growth has significantly outperformed value, except in this 2022 period where value did outperform, but that did not last long, and we went back to regularly scheduled programming right here, where we actually went and broke the high. So I would continue to say that based on this chart, any dips you do get in growth names should just be looked as buy side opportunities, especially with rate cuts, economic growth, and where the market is at the moment. Now, looking at minimum volatility versus the global index, again, it pays to be invested in high beta against minimum volatility or the market as a whole, simply because minimum volatility only really outperforms in downturns. Now, looking at the US index versus the world index, and the USA has completely outperformed the global index since 2008, the global financial crisis. It has been one-way traffic all the way up. We also saw this in the lead up into the tech bubble, and then from 2002 to 08, we did see the rest of the world outperform the US, but since then, again, one-way traffic, and I don't expect this to change. Now, looking at the yield curve, this is the 10-year yield minus the 1-year yield, and the yield curve is still inverted. When we cross above the zero line, that's when we uninvert. Now, a lot of people look at an inverted yield curve as a recession indicator, but it's not actually the inversion of the yield curve that predicts the recession. It's actually the uninversion. Once we invert, then uninvert, that's when we get the recession in 01. That's when we get the recession in 2007, 2008. You'd see the same thing right here. 2020, we had that very, very quick, mild recession, and the yield curve is yet to uninvert in 2024 after the Fed created this deep yield curve inversion with where rates currently are. Now, looking at data in the week ahead, guys, I spoke about this in yesterday's video, but we have the big ones are CPI, retail sales, and PPI. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video. Cheers.